Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi, everyone, and welcome to episode 27 of the Capital Mind podcast. Today, we're going to look at debt mutual funds. We've had a bit of a mini run on debt mutual funds over the last couple of weeks, perhaps an unexpected turn in this most recent market crisis. And it really came to a head this week with Franklin Templeton basically stopping new investments and redemptions from 6 of their funds. So today, we wanted to get into debt mutual funds and really ask the question, how do you know if your debt mutual funds are safe? How should you look at them? And what's really been going on? So on that, Deepak, welcome to this episode. And let's just get started. Can you first sort of lay the landscape for us? How big are debt mutual funds? There's been so much success with the mutual fund Sahi Hai campaign. It seems SIP inflows are 6,000 to 8,000 crores per month. So how do debt mutual funds compare against size, against fixed deposits? After all these years?
Hi, Shray, and awesome always to be on this show. Let's look at debt mutual funds as a category. We've got a fairly large number of funds. Most people think of mutual funds as equity, but obviously they're debt as well. In fact, more than 50% of all mutual funds are debt. So roughly 25 lakh crores is in mutual funds as of I think 31st March 2020, and 13 lakh crores out of that's roughly a little bit more than half, is in debt mutual funds. This is a fairly divided, in the sense you go about liquid funds, which are more short term. People keep them for 1-2 days, few days, a week kind of liquidity. That's about 6 lakh crores. And 7 lakh crores is in other debt mutual funds, the kind that have seen the carnage recently because Franklin shuttered about 6 of those of their funds in that category. And the rest is equity and maybe hybrid and a bunch of others. So if you look at the size of the FD market, people who have term deposits in banks. I'm saying term because this is different from a current account, a savings account, and all that stuff. That's about 73 lakh crores roughly. So the FD market is 6 times the size of the debt mutual fund market. So it's relatively small. And remember, there's a little bit of overlap. So debt mutual funds sometimes park their money in FDs with banks. So it's a bit of a mixed affair over here. But roughly speaking, if you look at the size of the market, FDs are significantly larger. We've got about the whole money supply in India is roughly about 150 lakh crores, right? So half of that is in fixed deposits with banks. Around 30-40 lakh crores is sitting with maybe 50 lakh crores sitting with government bonds, a government fund, in government issued by the government, and then the rest is in retail deposits. So 70 lakh crores in FDs. And debt mutual funds are nascent in comparison.
All right. So interesting numbers over there. It is a bit surprising, but perhaps intuitive that FDs are still, as you said, 5 to 6 times bigger than all of debt mutual funds, despite whatever little bit of double counting there may be. So let's now look at what purpose these debt mutual funds serve. So in general, why do people go to debt mutual funds? There was a lot of attempts to recast debt mutual funds as a more tax efficient fixed deposit replacement for individuals. I don't know if that succeeded. But can you sort of answer this question as an individual? When should I be going to a debt mutual fund? And as of today, who are the biggest clients for these debt mutual funds? Is it institutions like with everything else?
Yes, in fact, I think a significant number of 84% of liquid funds, for instance, are held by corporates or institutions. Only the remaining is held by individual investors, and more than 50% of the remaining is again held by institutions. Now, why do they do this? The question is, you want to go to a debt mutual fund for a purpose. Now, you might go and invest in any fixed income instrument. You could buy a fixed deposit. You have to typically get, the kind of returns you're going to get, and it's going to take you, let's say, a year to get that return. But in the intermediate time, if you need any money, and that money will be therefore you lose a certain amount of interest. So if you put say 50 lakhs into a fixed deposit and you need 10 lakhs out of it in 6 months, you typically either have to break the entire deposit, or if you take out the 10 lakhs only in some kind of a linked scheme, that 10 lakhs would have earned you less interest even for the last 6 months, that it was still as an FD, simply because that's the way FDs operate. Second, you don't get very short-term FD, 7-day, 10-day, 15-day. That is the kind of liquidity that people want to park short-term money in, especially corporates and institutions, and they will kind of drive it to be parked over there. Debt mutual funds also have this benefit that if you invest in it for 3 years, you get compounding on a regular basis. So the debt funds themselves go and buy other fixed income instruments, right? So it's like a vehicle, not the end use. So when you give a bank an FD, the bank is going to give you interest. Whereas in a debt mutual fund, what they do is they take your money, they invest it in other paper debt instruments, maybe of corporates, maybe of the government, maybe of state governments or public sector units. They get the interest and then they reinvest that interest back into buying more of these debt instruments. If you don't take your money out for 3 years, this compounding works tremendously in a favorable way for you for taxability, and that essentially means that you will pay substantially lower taxes, and we've calculated that you could actually pay 80% less tax if you hold a debt fund, giving roughly the same interest as an FD. If you held it for more than 3 years and held it and kept it for longer and even took out money from it time to time, you might pay substantially lesser than the amount of tax you pay on a fixed deposit. So there's a huge tax advantage as well for individuals holding it. Third, they sold. Institutions generally don't pay commissions. They go direct. So you see the direct ownership from an institutional perspective is nearly 90-95% perhaps. But retail individuals are sold these products. So they buy funds saying, okay, you'll get a better yield and you'll get a better, more tax efficient yield from go to these top mutual funds, and then they buy their debt funds. Debt funds can charge as much as equity funds in terms of management fees. So if a debt fund will charge you, if an equity fund will charge you typically 1.5%, you can find the top debt funds in terms of credit risk or some of the others. I'll talk about those in a bit. But those funds may also charge about 1.5%, which means if they're investing in paper that gives them 10%, you get 8.5. Now for you, 8.5 is great because there's no FD giving you 8.5. But the 1.5 is a huge management fee for a debt fund. And so that's why, for them having, since there's so much money in debt funds, roughly as much as there is in equity funds, the fact is that they earn quite a bit from the debt fund AUM as well. So these funds are also sold aggressively, at least the riskier funds, which turns out to be riskier now. They were not sold as risky funds, but they're mostly sold as FD replacements, saying, listen, come here, you'll get a better return. You can get it for longer term. You can get it as more tax efficient. So that's the reason. As an individual, I think you should go to a debt fund because you don't need the money and an FD will tax you on intermediate income. There are very few things that don't do that. Like there's an RBI 7.75% bond that gives you 7.75% per year, but your money is locked in for 7 years. And at the end, the interest is entirely taxable. However, in a mutual fund, if you got even 7%, and it was taxable at a much lower rate because of capital gains, and you're not locked in for 7 years, you can take out parts of it in the intermediate time frame, and you will always you'll have the liquidity, you'll have a tax advantage, and if you understand the debt product well, you could manage risk also quite efficiently. You will be taking a little bit more risk, but I think this is what the positives are of debt mutual funds in the longer term. And few accidents aside, the market is relatively small in India, and we're going to go through a bit of damage. But I think this market is only going to grow.
That sounds very convincing. I mean, if paying 80% lower tax for an equivalent interest rate and having the benefit of greater liquidity, it's a pretty compelling pitch. I mean, I can see why this does so well. But there's a lot of variety in debt mutual funds, right? I mean, I would like to think an FD is pretty much an FD, although I guess it might not be. But sticking with debt funds, what are the different kind of debt funds out there? I mean, what's the universe like? And surely they're not all created equal.
Yes, in fact, here's where the advanced financial education of this country comes in handy, because we have managed to muddle the field with so many complicated names that in the end you need a degree just to understand what all of this means, right? So we'll do a more detailed workshop on this, in the sense of saying, how do you select a debt fund, what kind of products are there, and what kind of stuff do they invest in. But I'll give you a brief here. You take a debt fund and you kind of base it on the kind of risk that you want to take. You want to take something that is shorter term in risk, something that's longer term in risk. Now remember, you have to think of yourself as a bank, because the mutual fund is just investing your money in other things. So if you want your money back within, say, a week, you're not going to invest in a product that buys something that is 5 years away to maturity. So let's assume your mutual fund invests in a fixed deposit, and that fixed deposit is 5 years away, and you're investing only for a week. You're actually not aligned properly with that fund. So either one is your liquidity, your duration that you want to invest in determines the kind of fund that you invest in. Most corporates, for instance, may have 3-day paper. There's something called liquid and overnight funds. So they're very, very short term. So they also tend to get their money within sometimes overnight, which are called overnight funds. Liquid, which is within 3 months. So you want money within 3 months, you want to park money for a short while, you want to use a liquid fund. As you get higher and higher and higher in terms of the term and duration, you might say, I want to expand a little bit in terms of horizon. So I can say, listen, I'm comfortable with something that's between 3 and 6 months. I want to invest in something that invests in the 3 and 6 month reason. Now, there's many reasons for this also. You may not necessarily know, but we'll come back to that. We'll say 3 to 6 months is called ultra short. 6 to 12 months is called low duration. These are all duration based, okay? And then there is the kind of market they invest in. So with something called the money market, we can go into details about that. There's something called commercial paper and certificates of deposit. We'll talk about that. Less than 1 year to maturity. So I give mutual fund some money. The mutual fund goes and says gives Reliance some money, but Reliance returns the money back within 1 year. That is the money market. So you want to invest in money market funds. There are a bunch of funds over there. And then you can go into more specific kinds. So there's something called corporate bonds. Corporate bonds are where they will go and give it to corporates who are rated AAA or AA. To the normal man, it means very highly rated. This does not mean anything, because rating agencies typically don't know. They rated ILFS AAA, DHFL AAA, and those guys didn't return their money. But the idea of rating is that, we have a very high chance of money coming back. Because those corporates are sound. So these corporate bond funds tend to invest. It can be something that matures in 3 months. It could be something that matures in 5 years, or a combination of the two. It's just that the fund managers now deciding what to invest in, as long as it's AA or higher. Then you get the credit risk funds, which are basically, less than AA. So a little bit less chance that your money will come back as a whole. But, we like this company, it just does not have the rating capability, but, he's sure to return the money. The fund manager takes that risk and takes that call. And you kind of give that your money to such credit risk fund managers. These classifications changed only about 2 years ago. So earlier they were called different names. And then you have something called short term, medium term, long term. So short term is more than a year, but possibly less than 3 years. Now the idea over here is, it's not necessarily that you want to invest for that time. It's that the fund will invest. Each instrument that it buys should roughly, the money should come back. And we'll talk a little bit more about how this is true in theory, but not in practice. But in general, the idea is that if I feel interest rates go up, I want to be in shorter term paper, because I want to be either in liquids or ultra short term or low duration, something like that. If I feel interest rates are going to fall, I will be in longer term paper. So I will actually want to position my debt funds in that way. interest rate cycles take 2 to 3 years. So in 2 years, it's likely that interest rates keep going up. Another 2 years, the interest rate can keep coming down. When the cycle changes, you might change your debt fund allocation metrics, but these are the different kinds of debt funds out there.
All right. That was extremely helpful. I would like to just second that point you made on how complicated these can become. I remember many years ago when you were still reasonably okay with people buying Franklin Templeton Ultra Short Term, which, by the way, congratulations on getting out of earlier this year. But I remember you had shared advice on the Slack channel for people to go and buy a fund. And even though you had given them the exact name, it came with 4 different subsets of options. I think there was growth, dividend, or whatever. And between all of those, they still couldn't get to it. So you're very right in that the waters are constantly muddied and not made very easy for you to do this yourself. But yeah, please.
One thing, Shray, I want to add over here. Yeah, I forgot to add that every of these funds has a dividend and a growth option. Dividend means they pay out in the middle. Growth is where they don't. They reinvest all the money that they receive. This has been a very interesting thing because debt funds, in general, there has been a tax arbitrage as well earlier. That tax arbitrage is gone now. So if you're a person who took dividend in a mutual fund, you were in a lower tax bracket, it was a different deal versus taking a growth fund and so on. So those things change. And then every fund has a direct and a regular option. So there's regular dividend, regular growth. Direct dividend. And what's the difference between regular, direct, and regular? Somebody gets paid a commission, some intermediary. You hear of an ICICI Direct. They are only selling regular funds. Whereas a direct fund can be bought from ICICI Mutual Fund directly on their own website. So it's very complicated. But here's the deal. Direct is the best option for you if you're listening to this and you want to take action by your own. If your advisor is listening to this, most likely he might tell you about the regular option. Because he'll get a commission. That's how he gets paid. So that's 4 of those. And Franklin, of course, I think thanks for that. We successfully managed to exit because we were looking at a certain set of dynamics, which we'll talk about a little more in detail later.
So let's get to the other side of this. You've now talked about what kind of debt funds there are, or debt mutual funds rather. So then what do they go and buy? Are all of these just like loans to companies, or are there different kinds of varieties to the instruments that these debt mutual funds invest in?
Okay, this is actually a very good point. Here's the thing. What banks do is give loans, right? So when a bank gives a loan, it goes to the corporate or somebody or a retail individual and says, here's my money, give me my money back. It doesn't tell you that, listen, if you don't give me my money back, I won't pay my depositors back. The depositors get their money as, the FD people get their money as it is. Even if, Nirav Modi comes and frauds the bank, no Punjab National Bank depositor lost any money. So the idea over here was that the bank took the risk. A debt mutual fund does not take the risk. So when it lends to a corporate and the corporate defaults, the investors of those debt funds will lose that money. So the higher returns comes with a slightly higher risk. Now think about it as a bank typically will give out loans, but there is another way for a corporate to borrow money. A corporate or any person can say, I will issue you a security. So your FD receipt, if you may, is like a security. Now, if you think about an FD, a fixed deposit, once I buy it from a bank, I can only give it back to the bank and say, redeem it for me. But think of yourself as having something that is an FD that could trade. So I take an FD from a bank and then I've got it at 8%. The bank now reduces its FD rates to 6%. So now my 8% FD should be valuable, right? Because you might look at it and say, Deepak, you have an 8% FD, I want it. So I look at you and say, listen, how much are you willing to pay for it? No, you paid 100 rupees for it, I'll pay you 100 rupees. I'll say, no, because 100 rupees, I'm getting 8%. Why should I bother giving it to you? Because if you gave me that 100 rupees and I try to put it back into the bank in another FD, I will get only 6%. So essentially that is more valuable to me than paying it to you. So you say, well, you know what, why don't I give you 110 rupees? So, then you've set a price on this FD, which was 100 rupees to start with. You're paying me 110 rupees just to buy that FD off of me. Why? Because for you, getting it 110 rupees means you'll pay 110, get 8 rupees on that 110, which is a 7.1% yield return, right? And that 7.1% return is more than the 6% you can get in a bank in an FD. So you're happy, I am happy, because I have now sold my 100 rupee FD for 110. So if you look at it as equivalent, if I had to get something equivalent to 6%, I might ask for 125 rupees. So my 100 rupee FD has gone to 125 rupees because the interest rates have fallen. This is the same way that you will find securities trading. So instead of thinking of tradable FDs, think of bonds. Bonds are just like tradable FDs. Once the issuer, which is a bank, which is a government, or which is a company, issues a bond, it says, I will pay you a rate, an interest rate. It's called a coupon. And that coupon is, say, 7% or 8%. Once it says 8% for the term of that bond, 1 year, 2 year, 5 years, 10 years, 6 months, whichever, the interest rate will continue to be that same percentage. So if it says 8%, it's going to be 8% for the whole term. The point is, in the middle of this, while this bond is, after it's issued and somebody has bought it, interest rates can go up or down in the market. And that will then determine whether another party will pay more or less for it. This is tradable. This is traded on exchanges. Sometimes the 100 rupee bond will trade at 102 rupees. Sometimes it will trade at 98. What mutual funds do is buy these instruments. So we'll look at different kinds of instruments. We'll go into more detail, in the workshop. But there is short-term concepts. There's something called a commercial paper and a CD, certificate of deposit market, where banks and corporates issue. These are money market instruments, they're called. This is sort of like bonds, but they're issued for less than 1 year in duration, right? And the government itself issues a lot of bonds. It issues bonds every week, in fact. You can buy directly from the government, but then you'll have to pay tax on the interest and all that stuff. So you go buy a mutual fund which buys government bonds instead. The government bonds can be bought as less than 1 year in duration, which is typically what are called T-bills. And something that's more, which are called government securities, G6 they're called, which are typically from 1 to as much as 50 years in duration. So that's, in the term to maturity. So you got those, you got something called bonds, non-convertible debentures or bonds, NCDs they'll call them. These are typically more than 1 year when they're issued. You can have extremely short-term, overnight instruments. Give me money today, by 3 o'clock tomorrow morning at 9 o'clock, I'll give it back to you. And for that overnight, I will give you, say, 4% interest divided by 365. So if you give me 1 crore rupees, it will be roughly, maybe about 10,000 rupees for an overnight interest. But there is that also. So the overnight funds will invest in the overnight stuff. The short-term funds will invest in the short-term, less than 1 year kind of instruments. Again, there are caveats here, but there are also funds that invest only in government bonds. They're called gilt funds. They will buy only government-issued paper. What's the difference? The government will not default. It can print money and give it back to you whenever it wants, if it were really, really, really in trouble. But a corporate does not have the ability to do that, so they're more risky. A bank is somewhere in the middle because there's an RBI sitting and saying we'll rescue all the banks. So the paper of riskiness of the underlying paper, which is that whether a company will return money or not, is also reflected in the price. So if a company was great yesterday and suddenly because of the COVID slowdown, you suddenly think that, oh God, it doesn't have any money, it's not going to get any money for the next 2 years, it may not be able to pay its money back. The minute you start saying that, the bonds itself become less expensive because you want to sell it, nobody else wants to buy it. So there's that credit risk also. There is also these other bonds where we've seen this most recently in the Yes Bank additional tier 1 bonds. These are a specific category of bond. Now, bonds are, a financial engineer's, wet dream, if you may. It's like a phenomenal thing for them to just keep adding layers and layers of complexity, and people will largely not ignore the complexity. So one of these are things called additional tier 1 bonds. Now, it's a very simple concept. Please give me money and I will never have to give it back to you. But I will pay you 10% interest per year. So you say, wow, this is fantastic. Will I never get my money back, or will you just pay 10% per year? No. If I'm in trouble, I will never give you any money or your principal or your interest back at all. I will just say goodbye and you will never hear from me again. So you're like, oh my God, but that's risky. Yeah, but you know what? You're getting 10%. And then people say, oh, wow, this is great. And then I'll add another clause saying, listen, after 10 years, no, maybe if I really like you, if I like this whole situation, I will I will buy you or I'll pay your principal back. These are called additional tier 1 capital bonds. These are fairly large issuances now, about 30 odd thousand crores or 50 odd thousand crores that have been issued by banks. And in recent case, when Yes Bank went down, people said, listen, you guys had said, no, you'll buy these bonds. And when we were in trouble, we could say, bye-bye, we won't give you your money back. Well, that time has come. We're not giving you your money back. So people went, oh my God, what do you mean? How can you not pay our bond money back? But answer was, that was the contract. It was the way it was written. Except it was sold to retired people and poor people. I mean, not poor people. 10 lakhs per bond is not necessarily poor, but there were people who were not informed of the risks, and then they ended up saying, oh my God, we thought it was like a fixed deposit, except it was not. So 81 bonds are also held by mutual funds, who also, by the way, lost money in the Yes Bank fiasco. But they didn't have a pretense that they didn't know. They knew they were taking that risk, and they're sophisticated people, so they shouldn't have pronged it on. But remember, the mutual fund did not take the risk. It was the investor in the mutual fund that took the risk. So in the end, there are multiple such debt instruments that mutual funds buy. You can see this every month in a mutual funds portfolio, and figure out exactly what they own. And in order to figure that out, you need to know what all they can own and why they perhaps own what they own in the first place.
All right. So interesting stuff there. And as you said, let's go into more details about the securities in the workshop when we have it. I have two quick technical questions. I'll club them together, and then you can take them as in whatever order you prefer. So if I were to put 1 lakh rupees in a debt mutual fund tomorrow, how does that 1 lakh get deployed in the debt mutual fund? And to some extent, why do I care? And should I be putting in money now? And the second question is, how do debt mutual funds calculate NAVs, since debt seems a little more complicated than equities where you have stock prices every day? And do I really care, or is this technical stuff I can ignore?
No, this is very, it's interesting because in a crisis, this is the only stuff that matters. In normal times, this stuff does not matter. So let's look at a normal time. I am a debt fund. You're an investor. You send me money. What I'm going to do with that money is go and try. You would think that I would try and buy something from that money in the debt market that will give you a good yield. So maybe I'll go buy a government bond at 7%. And that 7% comes to you minus my management fee of say 0.5%. So you get 6.5%. Fantastic. This sounds great. But actually what happens is you're investing, someone else is redeeming. So you give me a 1 lakh rupees and that guy is redeeming 1 lakh rupees. I won't even take your money and invest it in the market. I'll just take your 1 lakh and say, okay, this is cash. I will give it over to the person who's redeeming. So I have cash inflows and cash outflows. So what are my cash inflows? My cash inflows are when you give me money, that's a cash inflow. So I've also got bonds, right? I've got hundreds of bonds in my portfolio, and those bonds pay me money. Interest or principal regularly on a regular basis. So you might give me 1 lakh, I might get 5 lakhs more from interest from all the bonds that I've already invested in. Now at the same time, there may be 2 lakhs of redemptions. I'll say, okay, I'll pay out the 2 lakhs of redemptions from your 1 lakh plus the 5 lakh I've received, 6 lakh. Now I have 4 lakhs remaining. I'll take that 4 lakhs and invest it. This is what happens in normal times. In abnormal times, things change. So what happens is you're putting in 1 lakh, but I have redemptions of 20 lakhs. I won't take your money and invest it in the market. Even though the yields are looking juicy, I'm seeing Reliance something at 10%, and I'm really looking at this and saying, it's a fantastic time to invest. You're looking at that and saying, it's a fantastic time to invest. I should give Deepak Shenoy my money and he will put it into Reliance debt and I will make that 10%. But except when you give me the money, I am not prepared to invest it in the market. I have 20 lakh rupees of redemptions waiting. I am a seller, not a buyer. I'm going and selling that same bond at 10% because I have to generate that 19 lakhs of additional liquidity beyond what you've put in to pay people. So when my outflows are substantially higher than my inflows, mutual funds are then therefore not going to be net buyers. They're going to be net sellers in that market. And even if you give them cash, so for instance, there may not be 20 lakhs of redemptions today, but I see redemptions happening everywhere, like right now. And we'll talk about that. There's been about 20 roughly, I think about 35,000 crores of redemptions in the last 1 week alone in debt funds, not counting liquids. So out of the 7 lakh crores that was sitting in debt funds, 35,000 crores has been redeemed in the last 1 week alone after FD has stopped redemptions in 6 of its funds. That's a lot of money, right? So when you're looking at that and you're a mutual fund, you're going to be saying, if somebody gives me money, I will keep it as cash, even if I don't have the redemptions today, because I expect the redemptions tomorrow. So if you're thinking that when you invest, that money is all going to go into investments in the market and you're going to get the best return, chances are that is not happening. So you may not get the best return, and you may not, your money may not be used to calm down the market. Now, typically what would happen is, if you were a direct buyer of the bond, you would go and say, listen, you give me bonds at 10%, I'll buy them, I'll keep them. So you take the bond, and what happens is, as a buyer, you calm down the market, right? So you're going in there, your buying is calming down the market. Whereas if you go through a mutual fund, your buying may not necessarily calm down the market, because the mutual fund itself may not go buy those bonds. They might just keep the money in cash because they're also scared that they're going to get redemption. So in effect, the activity of buying a mutual fund does not necessarily mean you participate in the market, and in fact it doesn't even mean that your money can eventually get invested in that market. So you got to be little aware of this. Now, how, again, coming to the other part of whether mutual fund, how does mutual fund calculates NAV? It's very different from equity funds. Equity funds is a traded price. So if something traded at 110 rupees, it traded at 110 rupees. If it's very liquid as a stock like Reliance, HDFC, TCS and all of these, you know that the price is reliable in the sense that if I wanted to sell at 110, I would get 110 out. Bonds, by and large, are very, very liquid. Why? Because a Reliance itself may have 40 different kinds of bonds. One that matures 6 months from now, one that matures 1 year from now, one that matures 2 years but has a option to be repaid 1 year from now. Another one that perhaps matures every 7 days from now. So there are different types of bonds, and not all of these. So if in Reliance shares, if I'm buying Reliance shares, your share is the same as my share. I can sell it to you, you can buy it from you, and it'll be the same thing. Whereas if you have some type of Reliance bond, I have a different type of Reliance bond. They're two very different bonds. So I might not want the bond that you have, and you might not want to buy the bond that I have. So the demand is very different. So liquidity is different. So what happens there? How do I price something where nobody has traded it today? It's a very complex equation. So if I have traded it, I'm going to use the traded price. If I haven't traded it, what do I do? Oh, well, you know what? Maybe some other bond of the same company has traded close enough. So I'm going to use that price as a proxy and perhaps use some mathematical calculations to figure out what this bond should be priced at. Oh, none of the bonds of this company have traded. Now what do I do? Can we then look at other companies that are like the Reliance and say AAA rated oil and gas stocks? Okay, let me just try and figure out if there's something else in the same range. I won't say oil and gas, but just say AAA rated for the same time frame. Then this bond, I can use another bond traded that's got the same rating and use that as a proxy, and then come back and trade my own, price this bond again. So is it worth 100 rupees, 105 rupees? We don't know, because nobody's tried to sell. So you're trying to figure out what the price could be. Then you use this matrix. So it's like, oh, has this bond traded? Has some other bond of this company traded? Has a bond of the same rating traded? Has any other bond of any other type like this has traded? If none of them have traded, we'll use yesterday's prices and do an extrapolation for one more day, and something like that. So there is a matrix like this that is put out by, I think, Chrysler or somebody every day, and they kind of give it to all the mutual funds. The mutual funds have to price all their bonds accordingly. What does this mean for you? And what happens is they take these prices and build the NAV. So I have 500 of one bond. What's the price? Multiplied by 500. That's the thing. Total number of total value I have is 600 crores. I have 600,000 units. So each unit is worth 1,000 rupees or something like that. So that's roughly what the calculation comes. This is the NAV. You buy at this and you sell at this to the mutual fund. What really happens is that if there are lots of redemptions, this may not be true, because the price wasn't real, right? It was extrapolated. It was calculated as if it was in the past. I mean, as it was calculated from values that are not necessarily tradable, reliable prices. So when people actually go to sell this bond, the theoretical price is 105. You get only 101. what happens then? You're actually saying that 101 is the price that you could have got, but nobody actually tested that you could have got it before this. It's just that when you went to sell it, you got 101. So in a time of a crisis, bond market funds will fall in price when there are sales, when there are actual sales in the market. You could have seen that in the last week of March. You saw it in the last 1 week. In the last week of March, liquid funds lost money. Why? Because people were so scared of the coronavirus, the lockdown and situation like that they started to exit a large amount of their liquid funds. And they exited a large amount of the liquid funds. Even paper that was 7 days later, people were saying, listen, this should be valued at 99 rupees 80 paisa and you'll get back 100 rupees in 7 days. They were saying, no, I'll give you 99 rupees 50 paisa for it. So they were giving much lower values for even something that was very short term in nature. There was fear and panic. And that caused liquid funds to lose money on a week-to-week basis. Of course, it came back after a week. So if you had invested only for 3 days, you might have actually seen negative returns, which doesn't happen in FDs, but could have happened in a liquid fund at that time. And last 1 week, you're seeing that with long-term bonds as well. In long-term bonds, you see that the funds have been selling. They've sold 35,000, he's received 35,000 crores of redemptions in the last 1 week. They're not going to, they don't have cash of 35,000 crores. So they're going to sell what they have to generate that cash. Some of those sales will result in a massive amount of, sales, and the NAV will fall because when they go to the market to discover the real price, the price will fall. So your NAV is at best a great thing in good times, and in bad times, it's really lousy.
Well, I have to say, those are a couple of very depressing technical answers. You've basically told us that as a small retail investor, even if there are people trying to raise money at terms that should be benefiting you, you may not be able to participate if mutual funds are net sellers at that point of time, because the 1 lakh you're putting in is probably being used to service other redemptions and you're not getting any access to the good stuff because they're not buying. And the NAVs that you see, well, are only as good as for the formulas that underlie them. And in a time of crisis, those formulas become increasingly outdated and you're looking at best case prices and perhaps not real prices. Not the most encouraging stuff, but okay, I guess thanks anyway. Now, moving on to my next question. You've written this great article, and I'll link to it in the show notes as well, where you've described that there's a big gap between the actual liquidity of the things that these debt mutual funds invest in and the liquidity that is sort of promised either implicitly or explicitly to a customer. And that there's all sorts of perhaps weird stuff happening over here. Can you talk about this? I mean, what's this gap, in the liquidity?
Yeah, so it's quite interesting. Now it gets into complex stuff, right? So now that we've understood that there's at best we've got some fairly unreliable parts which is called the NAV. It's reliable in good times, not reliable in bad times. Let's also go to the fact that you can disguise a lot of things in a lot of places. Now, one of the things that you can do is okay, let me give you an example of Franklin. Franklin had an ultra short-term bond fund. Now, ultra short-term means between 3 and 6 months of duration. So you're thinking, okay, you know what? Maybe he buys something that is 2 months to maturity. Then he buys something that is 8 months to maturity. And then in roughly average of the two is between 3 and 6 months. So you're okay. So worst case, you might find that, okay, it'll take me 8 months to recover all the money. In case Franklin says, I can't sell these because the market is bad. It can't sell these bonds in the market. So it has to wait for maturity. What it means is that I'm giving you this bond by this Vastu housing or whatever. And you're saying, listen, I don't know who this Vastu housing is. I'm not going to buy it from you. I'm saying, no, it's a good company. Don't worry, it'll pay your money back. No, you're saying, no, I don't want it because the whole market is dead and I'm also a seller and I don't want to buy anything right now. So I'm saying, what do? I can't do anything. This Vastu housing thing is maturing in 8 months. So the best thing I'll do is I'll sit down, I'll wait for 8 months. Vastu housing will pay me back my money and then I'll pay back my investors. That's what Franklin has said in a way. And there's no, I'm just referring to a company name. There's no indication or anything about Vastu housing or anything like that. But here's the how the funds think. You can wait for that much time and you'll get your money back. Now, when Franklin has said it shuttered all its funds, the bondholders are like, okay, we'll wait 6 months, maybe a year at max. It turns out they have to wait more than 5 years to get their money back. And why is that? is because the way this 3 to 6 month duration was calculated was based on a formula that had what was potentially, let us say, you could work around with it. Again, financial engineering comes into mind, and we have the best financial engineering minds in the country. So it's not easy. It's not. I mean, you almost admire this stuff. But what happens is that if something is 5 years in duration, that means 5 years later, 5 years to maturity, you think, okay, it's going to mature 2025, and that's 5 years, right? But the company could have given you something called a floating rate bond. Now, the floating rate bond is simple. I'm not telling you how much interest I'm going to pay you. It's going to float, which means right now I'm paying you 8%. If interest rates fall by, say, SBI's 1 year lending rate, that SBI's 1 year lending rate, if it falls by, say, 0.5%, instead of 8%, I will pay you 7.5. So it is pegged to the SBI's 1 year lending rate. This is a floating rate bond. And when do I change this? I don't change this like every day, because SBI could keep changing its rate. So as I do, once in 6 months, we will evaluate what SBI's lending rate is, and we will reset the interest rate on this bond for the next 6 months. And after 6 months, we'll do this again and again. And we'll do this for all the way up till 5 years. So we have 10 such points at which we will reset the interest rates. Now, to you, you would still think, you're a normal person, normal thinking human being would say, this is still a 5-year bond, right? But the calculations of duration, which is what has to come between the 3 and 6 months of for an ultra short-term bond fund, they say that, listen, the interest rate is resetting every 6 months, so the maximum duration for this bond is 6 months, according for the purposes of calculation. What happens, therefore, is a bond that, like an ultra short-term bond fund, can have a 5-year floating rate bond in its portfolio and still call itself a 6-month product. So you can have a lot of this, and a lot of this is happening in a lot of debt funds. I'm not saying this is only Franklin. Almost every debt fund has floating rate bonds in it. When Franklin has come into a situation where they've shuttered entries and exits, and they have to wait till the fund receives money from whoever it is invested in, you find out that you're going to have to wait 5 years. So what was a 6-month product is actually waiting for 5 years, which now becomes another risk. You're not just taking the credit risk or the interest rate risk in the markets. You're taking the fund manager or fund financial engineer risk in a way, because you don't know. And I mean, although these portfolios are public, nobody goes and questions this, right? So if you've done a duration calculation, it must be right. Why would you not, but it turns out that once you do the calculation, it might actually turn out to be not right in that mechanism. There is the concept that they use is something called Macaulay duration, which is just basically how long does it get to repay, except in case of floating rate bonds, the Macaulay duration is used to the nearest interest reset date, which is, according to me, wrong. We've talked about in this thing and said, listen, you shouldn't use for average maturity anything with Macaulay duration up to the reset date. You should actually use the whole thing for the sake of maturity calculations. You can change you can do pricing based on Macaulay duration, which is how much should I price this bond is based on the interest reset rate. That's perfectly fine. But when I'm calculating time to maturity, it should not be based on this formula. There's also, if you think about a bunch of other abuses, we talked more about in the article. There's unlisted bonds where, because of SEBI rules, you can't sell them anymore. So you have to list those bonds. Many of those bonds can't be listed because the companies simply don't have a good standing. And therefore, those unlisted bonds sit on portfolios, and they might sit there for years and years. So when funds receive redemptions, they can't sell the unlisted. So they keep selling the listed. Now, if you give me... if I have 10 eggs and one of them is rotten, okay, I'm saying rotten because for just the purpose of it. If you ask me to give you 4 eggs, I have to give you 4 of the good ones. You're not going to buy the rotten egg. So now I have 5 good eggs and 1 rotten egg. So my rotten egg percentage was 1 out of 10 earlier. Now I have 1 out of 6. So as I get redemptions, the debt that can't be sold increases as a percentage of my portfolio. Right now, 1 out of 6 is like what, 15% or 16% really, and 1 out of 9 is 10%. So my bad egg percentage went from 10% to 16% just because somebody came and took away the good eggs, or I had to sell the good eggs. So if redemption wise also, you get a lot of these bonds which can't be sold, and in this case it can't be sold because of regulation, that it become increasing weights in your portfolios, simply because of a SEBI rule. So according to me, SEBI should allow funds to say, take these bonds, put them in a separate sequestered portfolio where returns will come only when those bonds mature, and you have a concept of segregation, a side pocket, which can be kept by funds whenever certain things happen. According to me, SEBI should allow that to happen. But what this also means is the actual liquidity that you've been promised is not the same as, so for instance, you're buying credit risk fund, they tell you can redeem every day, but they're investing in products that are either illiquid or long-term in nature, or long-term, repackaged as short-term with this floating rate concept. Except when you want to take back your money, you can demand it anytime you want. If enough people demand it, those underlying bonds are illiquid in that time frame. So what they've done for liquid funds is to say, listen, people will keep demanding money from you, so keep 15% of your money in government bonds. Why? Because government bonds can be sold anytime. There's always a market for them. So you say, okay, well, I'll keep 15% of my money in government bonds, the remaining, so I can have 15% redemptions. Now, I talked about 35,000 crores of redemptions in credit funds, in non-liquid funds. 35,000 crores out of 7 lakh crores is only 5%, right? So you had a 5% redemption. If all these funds had 15% in government securities, they would easily be able to meet the redemptions without having to go to the market and destroy the market and the market's frozen right now. So you, to a certain extent, so you really have a crisis because the instruments they have are not liquid. So you can introduce liquidity criteria as well. The last bit is where, you've got debt which is not necessarily really good debt. So there are companies owned by promoters of, say, public listed companies. And some of those promoters have borrowed in their own personal names. They won't tell you why they've borrowed it, but they've decided, okay, listen, I will give you shares of my public listed company, which are trading at 500 rupees per share. And I will borrow 250 rupees. So you have 2x cover for the share per share. Except what are you going to do with the money? I'm not going to tell you. And I'm just going to give you the shares as collateral. Now, I cannot do this to banks. Banks say, listen, no, I need to know what you're going to do with the money. So the banks will not lend. You can go to a non-banking financial company and there are upper limits on how much they can lend to such companies. But then you go to a mutual fund and you say, listen, I'll issue a bond which is secured by 2x in shares. And the mutual funds then can go buy it. Now, the mutual funds are not taking any risk. It's the investor that's taking the risk, right? But in good times, this happens, and the mutual fund promoter, the promoter company says, listen, I'm not even going to pay you interest every year. I'm going to take a loan for 3 years and pay you the entire thing as a lump sum interest after 3 years. What happens after 3 years? I come back to you as a mutual fund, and the promoter company comes back to the mutual fund and says, listen, you know what? It's time to pay that interest, but obviously I don't have any money. But here's the thing. Let's reissue another bond. You buy it. I'll use that money and pay you back for the first one. So these are promoter companies which use only shares as collateral, and they keep rolling over the loans and never really paying any interest. They're called zero coupon bonds. Or cumulative bonds, and they are just rolled over forever and ever and ever. Except when it comes to a time like this, when people are redeeming, nobody wants to buy that bond. Well, everybody's aware this is a company without underlying cash flows. I am not going to buy its bonds, even if you paid me to buy it. Or maybe if you paid me to buy it, I'd buy it. But other than that, I will not, pay any good money for it. So you want to be careful that your mutual fund or mutual funds in general are not the only lenders to these companies. If they only borrow from mutual funds, they have no operating business, they have no cash flows, they're not paying any interest. Actually, they're only accumulating it and then paying it at the end of the term. then I think you've got a product where you as a mutual fund investor are actually taking this risk, not anybody else. So the actual liquidity of the underlying investments that are in a fund are very different from what you're being offered. So therefore, you have to go a little bit more in detail and find out what the mutual fund is investing in.
Okay, that's extremely sobering and a bit of an eye opener. But so let me ask you, I mean, since at least I didn't know that there was so much going on in the debt mutual fund space, do we also need to look closer at fixed deposits? For instance, I doubt that loans to companies, which is apparently what you said the fixed deposit money goes on to do, surely those aren't all that liquid either. So are FDs actually much safer, or is this just untested and one day a similar problem can happen if there's a 35,000 crore liquidity request on fixed deposits in 1 week? Will the same crisis happen there?
The two things about FDs that will change, or three or four things maybe. So the FD itself has a rule that says you got to put about 20% of the money received in an FD into government bonds. So that liquidity requirement ensures that if there's a sudden run on the bank, that the 20% at least can be used to pay off depositors. This happened in Yes Bank's case, where a lot of people tried to take their money out, but the bank did have a substantial amount, I think 70,000-80,000 crores in government deposits, which would have government bonds, which could have been sold. And remember, banks also get a credit line from the RBI, which means they can take their deposits and go to the RBI and say, give me money, and RBI will give them money, no questions asked. So they have a lender of last resort for them. So they can go and borrow from that lender. Mutual funds don't have that access. Third, you've got the RBI saying that it won't let a bank go down and hurt depositors. So also there's a government guarantee of 5 lakh rupees per depositor. So that also ensures that at least a significant proportion of depositors will be paid back in case of an extreme situation, and that RBI will also act to, it has done this in the past. Yes Bank was rescued by a consortium of other banks. We've seen a massive amount of things earlier as well, where we've seen, I think a GTB was bought by Oriental Bank of Commerce. Even that was going down. It was merged forcibly. Bunch of other banks, Centurion Bank of Punjab, bunch of other things were merged into other larger, stronger banks, simply because the RBI wants to protect the banking system. There's nobody who's such a protector of the mutual fund system in a way. And in a way, remember, the lender is not the mutual fund. The lender is you as an investor. So don't expect yourself to be rescued because you're not too big to fail. The one other thing is that we've seen a lot of runs on FDs, typically the country and the banking system kind of works together to ensure that such runs don't happen. Because if you took out all your money from the bank as cash, you try to do that, you would bring down the whole country's banking system overnight. I mean, if enough people did it. But the fact is, the confidence has to be inspired by both the government and the RBI, and there's somebody doing that over there. In the US, I think things are different, because they're trying to save the markets as well. India, we're only been trying to save banks. So liquidity right now is much better in banks than in mutual funds, simply because they have a lender of last resort.
Why were you saying though that the RBI can't support mutual funds? Because wasn't there some sort of news release this week that the RBI is doing a 50,000 crore intervention to help support the debt fund market and stuff like that? Did I get that wrong?
I think I said the word wrong. I think shouldn't have said can't do that. They don't want to do, but they've done something. So what they've said is, listen, there's a problem in mutual funds, and mutual funds are not able to sell even good paper, because they're largely, they imagine if you got, there are multiple players in a market. There's the government which is selling. There is the which is selling bonds, so it's selling its own bonds. There are companies who are selling bonds, also buying mutual funds. Sometimes buying bonds directly. There are pension funds, insurance companies, insurance companies, and certain other funds which are buyers. Mutual funds are also buyers and sellers in the market. So you take one player and make it only a seller because it's getting redemptions, right? Then who will take their place? The question is, right now RBI is saying, let me push banks to take their place. I'll give 50,000 crores to banks. Banks will then go buy this paper from mutual funds. But banks will say, listen, if this is really junk paper, I'm not going to buy it. So I'm going to buy only some of the high quality paper. So maybe an NTPC bond because it's sort of quasi guaranteed by the government of India, or a bond from a company that has very little debt because I want to be safe. So they're only being very selective and choosy in buying a certain number of bonds. They've promised 50,000 crores to this market. Only about 12,000 crores have actually been taken. Now the next question is, will RBI then do more? The Fed, for instance, is buying even junk paper. They're saying, listen, we'll buy anything because we want to protect
Directly?
this market. Yes, they're buying junk paper directly.
Wow.
From the market, from companies directly. So RBI said, listen, you got to buy it from company, you got to buy bonds from companies, but only the high rated ones, and you can buy from the market as well. So literally half and half. But having said that, over here in the US and in fact in Europe as well, the central bank is literally buying anything. Now the Fed buys junk paper and that's considered bad, but the Swiss National Bank buys equities. It prints Swiss francs and buys equities.
You had mentioned this in the last podcast. Yeah.
Yes, and the central bank of the Bank of Japan buys owns 70% of their own ETF market, which is equities.
Gosh.
So these guys are way far down the risk cycle and saying we don't care. We will if we have to expand our balance sheet, print money and buy anything, we'll buy it. Now we've got a situation where none of the funds in none of the situations the RBI has actually demanded, but the RBI Act allows it to buy anything. It doesn't need any amendments constitutionally. So which means RBI can come tomorrow and say, I will buy junk bonds in India. I will buy good bonds in India. And that will not be a problem. Except RBI has not wanted to do this so far. It will be probably forced to if the market situation continues for longer. But in given where it is right now, I think RBI is saying, let me try everything else before I have to actually go and do this, which we've seen in the past, in the West at least, hasn't worked. Because when you do piecemeal things, no confidence is generated. Without confidence, people take their money out. And that's exactly what's happening.
So that leads me to my next question. Clearly, you were saying that there are some entities out there to whom mutual funds were the only liquidity providers. And similarly, the mutual funds are playing a fairly significant role in this in the CP and CD markets. So now that mutual funds aren't there anymore or are just sellers and have decided to take a backseat for the time being, what are the ramifications on that on the system? Is everything drying up? Are companies going to start going under? Is this going to be the next phase of the crisis, as it may be?
Oh, India's Lehman, yes, it could be, because what happened in Lehman was similar. They couldn't roll over paper in the overnight markets. When they couldn't, suddenly they realized that they had to file for bankruptcy. And if Lehman was allowed to file for bankruptcy, it means a lot of the counterparties they had would not receive their money. Now, what this actually means is that in India, if you have liquidity providers, which are mutual funds, which are saying, listen, we're refusing to buy any more paper. We're not going to roll over paper. We're not going to buy anymore. We're just going to be sellers. That means when it's time for you as a company to repay, instead of me saying, listen, you can repay me, and then if you want some more money, I'll give it back to you. I'm saying you repay me. I am not giving you any more money back. So a company who has salaries to pay would typically say, I'll need sometimes a loan, a working capital loan for 3 months, for 2 months, for six weeks, whatever. They might be rolling that loan over time, saying, I'll buy a ticket for 6 weeks, I'll pay it back, and then I need more money for the next 6 weeks. These are companies that have depended on these markets for years and years, and they've kind of calibrated their requirements to that. You've gone to a situation where they can't go to the markets and say, give me a loan. Now, remember, a lot of these don't go to bank loans because bank loans typically are pegged to something called the MCLR, a certain market-based lending rate. Now, that's a lending rate below which a bank cannot lend. So the reason is that, so the RBI says, listen, if you got an MCLR of say 8% for a year, that means you cannot give any other 1 year loan for less than 8%. If you have a 3-month MCLR for 7.5, you can't give a 3-month loan for less than 7.5. However, they can buy bonds where the return is 5.5 or 6.5%. That's a bank can do that, but a bank can't lend. So I can't if I have a working capital loan as a bond, like a 6-month paper or a CP or something like that. After 6 months, I might say, listen, I want to roll this over. The mutual fund says I'm not going to buy it. They are very large players in the CP market. So now what do? I go to a bank and he says, listen, the mutual fund may have been giving it to you at 6.5. I can only give it to you at 8. At 8, this working capital ruins me because my margins collapse and I might make losses. So to that point where a company which is a very large, which is a very highly levered company tries to borrow at higher yields, it will end up. I'll give you an example for an NBFC which lends to the housing market. It typically was borrowing at 6% and lending out at 10% because that's what housing loans are. Except now, if they go to banks and say, give me a loan, the banks will say, I'll give it to you at 8.5%. Now, at 8.5%, you have only 1.5% spread, and that's not enough to meet your own expenses and the fact that some homeowners may default and not pay you back. You suddenly start making losses. So you're saying, listen, I can't not borrow money, but I can't borrow money at this rate either. So you could have companies that it threatens to go under, even just because the interest rates differential is too high. And the other reason why banks don't cut their rates is if they cut their rates from 8% to 7.5%, every single loan in their book, which could be hundreds and thousands of crores, are linked to the MCLR, which means all those loans will start paying 0.5% lower interest rates. They are afraid of that. They don't cut it down on the way down. They raise it as soon as they can because that means people will pay more. They don't want people to pay less. So banks, therefore, having a backstop of these markets being bank lending is not entirely feasible, and system drying up will result in companies going under if it lasts for a significant amount of time. Now, we've only had about a week of craziness, about a month of the COVID related lockdowns. But if this were to last longer, I'm sure many companies would go belly up simply because of this. It's a little depressing as a thought, but in general, you would expect that no country or central bank will want such a system to dry up. Therefore, we assume that RBI will come in at some point, calm the markets down, and rescue it in some meaningful way.
Yeah, I was about to say that it looks like it's pretty inevitable that there's going to be a more active RBI for the rest of the year. So they might have to work weekends as well. Actually. So after hearing all the stuff you've said, I'm now particularly interested in what debt mutual funds I have and whether I should be exiting and how I should be thinking about them going forward. So you've talked about this workshop you plan on holding. Can you give us a bit of a teaser? What are you planning on covering?
I think the things that we talked about here, we talked in some level of like a summary level, but let's think about it as more detail. What debt funds do? How do you look practically at a debt fund and analyze what its return, what it's invested in, how you can look at the individual components of its portfolio and identify parts of it that are weak. For instance, AT1 bonds in certain portfolios. Sometimes they won't even tell you it's an AT1 bond. How do you figure that out? How do you know whether a certain company is good or bad when you've not even heard of its name? How do you look at the underlying basics of companies? How do you find out if your mutual fund is likely to be the only one lending to that company in the first place? Do you have a mismatch between what your expectations are of your debt funds and the way the debt fund is actually investing? Is there floating rate bonds in there? Are there a lot of unlisted bonds? A lot of bonds that aren't necessarily the most, the kind that you would have wanted. Remember, you're the one who's investing. The mutual fund is just the vehicle, and therefore it's a little bit of your money goes to each of these funds. So how do you practically analyze how funds are and perhaps how often this activity has to be done in order for you to be confident that you're in the right place? And looking at debt markets as a whole, because the NAVs that you see are determined by prices of other bonds, of other markets, you have to analyze the market as a whole. So I think if you were to do that more meaningfully, you would actually appreciate. At least be understanding of the risks. I think we deny ourselves. We say that we are astonished that these things happen. However, if we were to know more, perhaps we could take more meaningful risk-based assessments. So the idea of the workshop is basically how does how do these debt mutual funds, how can we evaluate them? Why should we select certain ones and not the others perhaps? And how to evaluate your debt portfolio overall in the context of things. So more detailed, very hands-on, taking you to websites, taking you to analysis and so on.
Sure, that sounds very actionable. Looking forward to it. Well, thanks a lot, Deepak. I'll hand it back to you, and thanks everyone for listening.
Thanks so much for listening, everyone. We're at capitalmind_in on Twitter, where I'm at Deepak Shenoy. Please feel free to ask questions. Visit us capitalmind.in for our research and content. Visit us at capitalmindwealth.com, where we manage portfolios, including debt fund portfolios. So a lot of this is actually practical stuff that we do on a regular basis. And stay safe, wash your hands, enjoy. I hope you like the podcast, and please let us know your thoughts. Thanks for listening.